Plenary on global decarbonization of road transport. With the switching of coal to natural gas and renewables in the power sector in the U.S., the transportation sector is now the U.S. sector with the highest greenhouse gas emissions, almost 30%. Globally, the transportation sector comprises about half of that in terms of the percent of greenhouse gas emissions. But the transportation sector has proved more challenging to decarbonize than the power sector. So the big questions we're going to address today is how is the transportation going to decarbonize, if it will, and when, what's the pace and the timing of it? And how will it occur? Will it be through electrification? Will it be through hydrogen and fuel cells? What role will efficiency play? And finally, how does automation and ride-hailing impact all of this? And does it help you decarbonize, or does it move you in the opposite direction? So I wanted to set the stage by showing a couple of slides. Columbia University Center on Global Energy Policy has done a survey, this is the second year in a row, of collecting all of the electric vehicle penetration forecasts and comparing them and trying to understand why they agree or differ. And let me just quickly explain the color coding. If it's black, it's an oil company. If it's red, it's a government organization's forecast. Other would be a bank or a consulting firm. And yellow would be a 1.5 to 2 degree low carbon scenario, to give you an idea of how this works. So if you look at this chart, it's a forecast of global annual electric vehicle sales in my most current survey, which has not yet been published, but should be published in the next few weeks on Columbia's website. And the thing you notice, and I'm going to focus on this slide on the right, which is the percent of sales, as opposed to the slide on the left, which is the number of vehicles. And what you can see is that you really have to get beyond 2020 to have electric vehicles be a substantial share of the sales mix. And so people who talk about we're going to have peak oil demand in 2020, you realize how difficult that is when most people aren't even expecting to see very large electric vehicle penetration before that time. And then you get to 2040, and in 2040, you have maybe 15% to 95% of vehicle sales. So that is I once worked for a CEO who said to me, that's a wide enough range you can drive a truck through it. I guess that's a Houston expression. But the point is, there's a very large disagreement in views, and these views have become wider over time. There are people who become more convinced it's going to happen quickly, and people who think it's not going to happen except via niche market. So again, wide range of views, and the most interesting thing to me was comparing this year's forecast that's about to be published versus last year's. And the chart on the left is 2025, the chart on the right is 2040. And you can see twice as many of the participants in the survey thought that there'd be lower penetration versus their views last year, in both time periods. So I was surprised to see that, and I expect, the reasons for that is I saw some skepticism in the survey about if and when batteries packs are going to get to $100 a kilowatt hour. The weakening economy means fewer car sales and also fewer electric vehicle car sales. So there are reasons why people have lowered their views about EV penetration. But probably the biggest reason was U.S. policy, both in terms of lowering fuel efficiency improvements as well as the fight that the federal government is having with California. And the last slide I'll show is what the survey said about passenger vehicle oil demand. And you can see that nobody believes beyond 2025 there's going to be any growth in that sector. And the views vary from it remains flat or it drops down to like 10 million barrels a day by 2040 and even lower, almost zero by 2050 in some of the more extreme low carbon scenarios. So that is the wide range of views. So with that as a backdrop, I'm going to introduce the panel we have to address these issues that I've raised. First, we have Lou Fulton. Lou is the director of the Sustainable Transportation Energy Pathways Program within the Institute of Transportation Studies at UC Davis. And Lou, of course, will focus on electrification. Then we have Amate Binon, the Vice President of Autonomous Vehicles and Mobility Innovation at Securing Energy, America's Energy Future, and he will focus mostly on automation. And finally, we have Paul Levy, who is a distinguished research scientist at Oak Ridge National Laboratory, and he's going to speak about the effects of automation and shared mobility on road travel, energy use, and greenhouse gas emissions. So, Lou, I ask you to come up first. And we're going to sit in the audience so we can see each other's slides.
And also make sure there's even more audience. Although it's not a bad looking turnout here. I wish the room were about a quarter this size, but. So thanks, Marianne. That's a great set of intro slides, and I'm just going to try to build on that. In our group and at the STEPS program, we have a plug-in hybrid and electric vehicle center. We have, oh, that didn't pop up. Let's try that again. Here we go. We have a Three Revolutions in Future Mobility Center of researchers that gets into this set of interactions between electrification, shared mobility, and automated mobility. And then we've got my group, which is doing energy futures kinds of projections, a lot like what Marianne just showed. And so we enjoy bouncing all those ideas off each other. I'll focus on the projections and what causes us all to either be enthusiastic about what we think electric vehicle futures might look like, if enthusiastic means a lot of them, maybe for some people that's not enthusiastic, and versus a more pessimistic outlook. And then I think the next two speakers will get into some of those other dynamics and think about how all these things bounce off of each other. So she showed some nice projections, comparison projections. Here's the actual data through 2018. Of sales around the world, well, actually, I think this is stocks, and we're up to about 6 million plug-in hybrid and electric vehicles, and it could include fuel cells. There's only a few thousand fuel cell cars out there at this point, but we're around 1.5 million sales a year, and I think what kind of shows up in this figure, maybe in the last year it's even getting stronger, is that almost all the growth now is in China. The increases in sales in the U.S. is basically flat except for Tesla. There's been a little bit of increase in plug-in hybrid plug-in hybrid vehicles, and a little bit of growth in battery electric vehicles, apart from Tesla, but basically the lion's share growth in the U.S. is Tesla, which is kind of an interesting thing. And we are getting some new high-end companies showing up now, and actually a couple of them are Chinese. So I think we're going to begin to see Chinese companies producing electric vehicles to be selling outside of China. So, you know, as often is the case, China's beginning to drive the whole thing forward. It's also a recent data point that I think it was in September was the first month, like ever, that electric vehicle sales around the world dropped. So that was kind of a little panic moment, although they seem to be back growing again, and they will be a lot higher in 2019 than they were in 2018. But it's still only 1.5% of light-duty vehicle sales around the world, 1.5 million out of 100 million, and the stocks at 6 or 8 million are, compare that to, let's say, maybe a little over 1 billion stocks on the planet. So it's well below 1%. It's like, well below 0.5% of the stocks on the planet. So we're still at, as Marianne was saying, we're still at a really early stage here. And even though things feel like they're moving quickly, you can imagine why some projections are relatively low and some are high. This isn't as good a figure as yours, but I liked the title of this article that was in quartz.com. Researchers have no idea when electric cars are going to take over. It's basically true. Nobody really has any idea. And one thing that would, if I were to put Marianne's slide back up, you notice that I assume the government agency projections probably EIA and maybe also IEA. Okay, so it's probably, at least certainly includes EIA, and they are doing a reference case where they're not really trying to bend the curve. They're trying to build on recent trends, and they end up with fairly low penetrations of electric vehicles. You get some who are very enthusiastic that we're going to get a tipping point and we're going to see sales just growing by 5% a year, in a big S curve out to, 2040. And then you also do have these low carbon scenarios that show something like that, but are actually really more like backcasts. And so we need to be careful to separate things that are backcasts from things that are forecasts. So forecasts are driven by markets, maybe by some assumption about policies. Backcasts are more about where do we have to be in order to achieve a target, right? So in 2040, you'd better be pretty close to 100% market share of zero-emission vehicles, along with a deeply decarbonized grid around the world, if you want to be on track for something like a 2-degree or 1.5-degree scenario. So it's very challenging, but it doesn't mean it's going to happen. So we've looked at this, and I'm going to report on our version of these kinds of curves from a series of studies I've been doing with Alan Jen, who's at the conference. I don't know if Alan's in the room. He's back there, hiding in the back in the dark. You didn't even know I was going to present this. I didn't warn him. But, and I'm actually going to focus, we're about to publish the third in a series of these, and I'm really focusing a bit more on the second one. But we got a hold of some global data on vehicle sales, and we don't know much about we don't really know anything about the people buying them in this particular set of data, in this particular analysis. But we were able to develop projection systems building on a few things that show up in the real data, so it's revealed data. We were able to drill down on different kinds of vehicle classes, so everything from small cars where electric vehicles tend to do well to large SUVs and, let's say, pickups where they don't tend to do very well. But part of it is there aren't very many models yet in some of these classes. We looked at the brands that are producing and to what extent branding matters. We looked at, of course, vehicle price and fuel cost, and then in the version of this that we did for the second paper, we also looked at engine power and range. And I don't think we're including range in the newer one, but I'll come back to that. So these all are part of a statistical model to try to understand the sales of electric vehicles in the historical data, which incidentally is between 2010 and 2017. And of course, with things changing so fast, we're trying to get the latest data through 2019 as soon as it becomes available so that we can keep updating this and, see this curve bending and how it affects our calibration of our modeling. But we estimated models. I'm not going to show you the details of that, but then we projected based on different assumptions about how the price of battery electric and plug-in hybrid vehicles may come down, mainly because the cost of batteries comes down. So there's a low, medium, and high case. They're hard to see, but the three lines are sort of a low, medium, and high projection of how much prices come down, a low, medium, and high case of how many more models, offerings of electric vehicles we see, and we find that that's very important, that obviously if you have no models, you're not going to get any market share. If you have more and more models for people to select from, and they may have 100 models in one country, in one market class to select from, and if there's 3 models of EV, you can't expect a big market share. So we project increases in that, all sort of exogenously, and then improvements in vehicle range, driving range over time. And so how does that change the sales and the market share of these things? And we end up with 3 curves, low, medium, and high. And we ended up with something between 25 and 100 million. And actually, if I quickly go back to what I showed a minute ago, in Marianne, some of them go all the way up to 100%, which would mean 100 million a year, and stocks by 2040 probably well over 500 million, but the 3 particular studies that are here, these stocks go up to 500 million. The highest in ours, well, I think by 2040 is only 100 million. So all of ours are below some of the projections that are out there in the literature. But there's one very important thing that we didn't change in this second analysis, which is basically the residual or the intercept term for how people view electric and plug-in hybrid vehicles apart from all the attributes of those vehicles, reflecting their awareness level. Are they thinking about it? Do they like the idea of it? Are they getting comfortable with it? Things are very hard to measure. And I won't show any slides on it, but in the newest version of this that we're about to publish, we do look at that, and we track that intercept term, and we do find that globally, on average, it seems to be increasing, that whatever it is, awareness, the interest or the willingness to buy those vehicles is rising over time after taking into account all the other factors that we include. If that continues to improve and more people are thinking about buying them and become aware and everything else, then the scenarios look better. And we have now got scenarios where we're getting a nice S-curve, and you can imagine that at least in some countries going up to 100% market share by 2040. But again, it's another sort of heroic leap that will continue to happen along with all these other attributes improving out into the future. So you need a lot of things to keep happening at a fast rate to get these high penetration scenarios. And, you know, maybe that'll happen. Maybe it won't. We don't have very many cases that we can do a deep dive yet where we have large market shares. You've got a few. Norway is somewhere around 30% market share. It might be interesting to understand the historical data in Norway, but Norway's not a very typical country. It's a very wealthy country. And as we go on, we hopefully will have more examples with a little bit higher market share, and we can track these variables. But I don't think we should be very careful concluding at this point that this is a fait accompli and we're just going to have this transition to electric vehicles. We could get stalled at a 5% global market share. Here's another project I've been involved in with the Global Fuel Economy Initiative, the GFEI, and there's a website, globalfueleconomy.org, and it's a bunch of research groups and also international organizations like the International Energy Agency and the UN Environment Program that work together to try to track fuel efficiency, and more we look at electric vehicles, and we create our own set of targets that we publish that we think have to happen in order to be on track to a low carbon future for road transportation. And in this new version that just got published in May or June, we now have created targets, and these targets are also somewhat bottom-up developed, with ICCT doing a lot of the work on what is technically feasible, how fast can things happen, taking into account a lot of things in addition to the target setting itself of reaching low carbon futures. And this is a bit of a messy slide, but you can see we've now looked at light duty, 2 3-wheelers, heavy duty, and buses. So it's basically almost all road vehicles around the world. And you can also see that the sales shares for buses go up the fastest. The ZEV shares, the dotted lines are the VMT associated with that. It's kind of also tells you something about the stock trailing the sales. 2 and 3-wheelers are the fastest, then buses, then light duty. And in this case, light duty does hit about a 60% sales share by 2040, which isn't that much higher than some of the projections that Marianne showed. And then finally, trucks. And so that's important. We probably should be talking a little today about trucks, although I think we'll focus mostly on light duty. But trucks are a hard nut. A lot of different kinds of trucks, a lot of different applications, and very specific needs that go beyond the kinds of needs that light duty vehicles have. So in any case, we have it on a much slower track, but still over 50% ZEV market share globally by 2045. And when you think globally, that means that what's happening in the US and Europe and China probably has to be well ahead of these curves. So I'll just leave that with you to think about. We did our own version of this for California. The curves are even faster. We've got, California has a requirement that all transit buses will have to be ZEV by 2030, so that's in our scenario. We've got light-duty vehicles reaching 50% by 2035, and all trucks except for long haul, and then long haul catches up. And I'll just quickly point out a couple of things of this new study for California. I think one of the critical things about how electric vehicles and hydrogen vehicles do is going to be the cost of the vehicles and the cost of the energy. And when we estimate and project out, our latest version of this, we see that battery electric prices are coming down, of course, and a 100-mile range vehicle can become cheaper than a ICE vehicle by 2030, but a 200-mile range vehicle does not until 2050, and that's, of course, the trend to longer and longer range battery electrics. So they may not become cheaper or even match ICEs for a long time, and so that's a big flag. And then on the fuel cost side, we have the battery electrics always being cheaper. Hydrogen vehicles do not catch up until around 2035, and that's with fairly heroic assumptions about reductions in hydrogen costs. So those are two of the big things that we need to also be tracking. Okay, last point is that for trucks, we also did a study of non-cost factors, a sort of generalized cost, and we found that currently there are, if you take into account the uncertainty associated with operating these things, is one way of calling it, refueling inconvenience and model availability, it adds on the order of $50 to several $100,000 per truck if you try to value that, which just for hydrogen, it makes it a showstopper. Over time, if you could overcome that and you sell a lot, these things come down, the problems go away, and by 2050, everything looks fairly competitive. The question is, how do you get through those very large valleys of death to get to competitive looking truck options for electric and hydrogen? Okay, so conclusions. EV sales, currently about 1.5% of global LDV sales must reach a large percentage of sales share by 2040 to be on track for low carbon scenarios. We have very little data and few examples of how this can happen yet because we're at such an early stage. Projections are generally based on extrapolation and some murky sense of technology change, cost reduction, consumer change, and policies to get there. And I haven't really even talked about policies, but obviously that's a key part of driving this. Fuel cells I haven't talked that much about fuel cells, but they don't have a clear path on vehicle or fuel cost to provide advantages. But there is still that possibility that the range and refueling advantages of fuel cells, which could be very valuable, could end up mattering, especially, I think, if battery electrics get stalled in some market segments at low market shares. Spending on incentives and infrastructure may have to continue for a while and may need to be higher, not lower than current levels. We're seeing in California spending that adds up to something like a couple of $100 million a year for infrastructure and incentives like government spending, whereas we're seeing on the order of maybe $20 billion by 2030 is needed to cover all the incremental costs. Then you may get into savings because of the lower capital costs and the increased importance of fuel savings out there. But that's a 10-year period when it takes a lot of investment and paying for incremental costs, and we're nowhere near the levels needed to really believe that you're going to cover all those costs. So, as a segue, maybe increases in shared mobility and automation can help to speed up the penetration of EVs. Thank you. Do we hold questions or? Okay. I guess this is you, right?
Thank you very much.
Doesn't have your name on it, right? Yeah.
Yes. Okay. Great. Good morning, everyone. Thank you very much for having me here. Marianne, thank you for inviting me to this panel. And I think this is very fortuitous that Lou ended with his views on the impacts of automation, because I'm going to pick it up from there and give our perspective on how automation might fit within the broader context of the goal of decarbonizing road transportation. And I think we're going to focus less on the technology, but more on some of the other aspects of what Lou had talked about, which is how consumer preferences or business incentives around efficiency change in a fleet-based or automated world. So by way of introduction, my name is Amitai Benan. I lead work in autonomous vehicles for SAFE. SAFE stands for Securing America's Future Energy. It is an advocacy group and think tank based in Washington, D.C., which is led by a coalition of business and military leaders. That's the chairman of our Energy Security Leadership Council, Fred Smith, the CEO of FedEx, and Jim Conway, General Jim Conway, the 34th Commandant of the Marine Corps. And together we formulate and advocate for policies to improve U.S. national and economic security by reducing oil dependence. And there's a supply side component to that, as well as a demand side component to that, by using technology to reduce our consumption of oil in the transportation sector. I lead our autonomous vehicle initiative, which seeks to harness new emerging technologies in mobility to get to this broader set of goals. We formulate our mission relative to autonomous vehicles to accelerate the safe deployment of autonomous vehicles and maximize the benefits of the technology to society. And this mission has two clauses in it which are strongly interdependent. One is we don't think autonomous vehicles will make it onto public roads unless there is sufficient demonstration and understanding of their safety level. So we work with the private sector, with standards bodies, with policymakers at the state, local, national, and international level to help understand what are the right safety frameworks. But the findings, or what drives the political will to take risks around new technology, is laying out a vision for what the technology can do in terms of solving societal problems, whether they are related to road safety, to energy security, to climate change, to accessibility, or thinking through what this means to the future of the workforce. So we engage in both modalities, both thinking through the right regulatory frameworks to ensure safety, as well as painting the vision of what a world in which autonomous vehicles are widespread might look like. So the context of this presentation is around climate, is around carbon. And as Marianne said in her introduction, based on the latest recent release by the EPA, transportation continues to be the largest sector of emissions. But not only that, if you look at the growth of total emissions across the last generation or quarter century, even as demand for services in other sectors and in transportation went up, the total emissions in most other sectors, including electricity, went down on net, whereas even though emissions per mile went down in the light duty vehicle sector, the growth in VMT more than outweighed that, and the total emissions in the sector are up by over 20%, of which about 60% come from light-duty passenger vehicles. So that's a very significant lever in terms of achieving carbon reductions. And it's not just a carbon problem, as we mentioned before. It's an energy security problem. Most 70% of domestic oil consumption goes towards transportation, and dependence on oil also has economic vulnerability implications due to oil price volatility. So how do we get there? And I think this is probably the most important slide of the presentation. So if I've lost you so far, you can come back in. And that is, this is a simpler version of a framework that I think Paul is going to present later. But essentially, we think about where transportation energy comes from. It comes from like three levers. The first is how many services we demand. And that's driven by really things that we don't think of as intrinsically tied to the transportation system, such as land use policy, as well as the fate of the retail sector versus online shopping, and or macroeconomic factors. But then, in terms of once there is a certain amount of demand, our system serves it it can be better or worse at serving it with a given set of miles, or stretching the use of our vehicles even for every mile they travel, by having it able to render more services or render more services across those miles. And then finally, I think what we think of as most connected to the energy implications of transportation are the characteristics of the vehicle, the powertrain, its weight, which has to do with materials. And so the reason I broke it up like this is for a couple of points. One is the factors that drive each of these levers are fairly distinct. I think of the middle lever around making the most of every mile we travel is really IT, information technology driven, around making sure people who want to share rides be able to share rides by using app-based services, or using software to manage traffic lights so vehicles can so traffic patterns can be optimized for fuel. And the last lever around emissions per mile is really very much hardware driven. And I think there's kind of two key points I want you to leave with. One is, so generally the actors who are relevant to each lever are generally pretty separate and disparate, so it becomes hard to coordinate action on each lever, even though there's some interdependency on each. And then secondly, from a policy perspective, and as someone who works in DC on fuel economy policy, is very stubbornly stuck in that last column. Our fuel efficiency policy is all about the characteristics of the vehicle that rolls off the production line, and very little about how it's actually used, and very little about the services it accomplishes in those use. And if we want to think about more holistically about how we can use policy or business incentives to improve efficiencies, a view should be increasingly holistic as possible. And the reason why this is critical builds off a theme that's been put in both of in both of the previous presentations, which is that there's mixed news around the individual consumer adoption of electric vehicles. This is from an IEA report. The top shows individual penetration in some markets, and the lower is disaggregated into some individual countries. Some countries have very aggressive stories and very aggressive adoption curves, and others less so. But I want to unfortunately share a little bit of the downside of the story, because there's also another side of consumer preferences and consumer evolution that has a negative impact on our efficiencies, and that's displayed in the share to the right, which is even as electric vehicles become more popular, SUVs have become more popular. And in the U.S., this actually understates the problem, because SUVs don't count crossovers, which are classified in the U.S. as light trucks. And if you count those, new sales of light trucks in the U.S. as a share of light-duty vehicles is over 70% at this point. There's an overwhelming consumer preference for a utility that is sized to their maximum use case. And when I mean maximum use case, I really mean their outlier use case, because if you look at the bottom right, this is a plot of how often for household trips, which makes up about 75 to 80% of light-duty vehicle use, how many passengers are in each trip. And just to summarize it, in about over 60% of our trips, there's just one person in the car, and in about 85% of the trips, there's one or two people in the car. So we keep on having bigger and bigger cars driving around fewer and fewer people. And so that's not a problem that working on the powertrain can fix. And it's a really important lever. This is some internal work we did, in which we showed what are the key drivers in doing carbon reductions. And this is solely from the set of trips done by households with just one or two people in it. And so there's a certain amount of So I want to focus on the middle two bars. Essentially, we simulated two scenarios. One in which all of these households, instead of doing the trips with their current vehicles, instead used electric versions of their current vehicles, and that saw a 300 megaton reduction of CO2. But if you instead of electrifying those vehicles, instead put people in a vehicle that was appropriately sized just to serve one or two people in it, which is not a very successful market segment, you would actually save about the same amount accomplish about the same amount of carbon mitigation. Obviously, the best thing is to do both of them, but the point is that it's not just electrification that's the right lever, but better matching the consumer demand for a specific trip with the appropriate right-sized vehicle to accomplish that. So that brings me to autonomous vehicles and why we think this has a role in solving both of these problems and integrating the multiple levers that drive carbon reduction. And so I'm assuming, as by way of background, everyone here knows what an autonomous vehicle is. It's a car that can bring a person from point A to point B with no driver inside, and that has pretty strong implications about the business model and incentives. And I'm not going to talk very long about timeline, but I know there's the recent narrative in press and coverage has been that the deployment timeline has been stretched out, and I think we concur with the view. We see autonomous vehicles being gradually deployed in about a decade or a decade plus long process, but we think that process has already begun just in the last couple of weeks. Waymo has announced that they've started to transport members of the public in Chandler, Arizona, without a driver inside the vehicle, which is, I think one of the first times it's happened in such an ambitious application in mixed traffic. Although Denver technically had a deployment of a driverless vehicle earlier this year in a very small office park where a shuttle went at low speeds around the office park without a driver inside. So Denver actually plays a key role in this, so very appropriate that we're here. But now on to autonomous vehicles. So one thing I want to point out, these are some autonomous vehicles that have been or are under development. And I think the middle top and the upper right, the truck and the minivan may look pretty familiar to you. But what's interesting, what you take away from this graphic is that a lot of the other types of vehicles there look different than the sort of vehicles you may be used to driving in day to day. And I think it's pretty telling that these sort of new form factors emerge at the very early days of automation, because as soon as you put automation into the picture, it opens up possibilities for businesses to optimize their operational costs by experimenting with a couple of different by experimenting with the hardware and some other aspects of the system. If you're delivering groceries, that implies a different sort of vehicle than if you're transporting people, and that already is starting to pop up. And here's the reason why we think this pops up, and the reason why we think electrification is a part of the story. Now, if you buy, I think most developers of autonomous vehicles will tell you that an early application and a main application, certainly vis-a-vis passenger transportation, will be an on-demand transportation, much like Uber or Lyft, except for the vehicle being autonomous. This does two important things that we think helps accelerate electrification. One is it increases utilization of the vehicle. Typical household vehicles utilize about 4% of the time. Consumers demand incredible rates of return to make an upfront investment on their vehicle hardware to save fuel efficiency. But with a higher utilization rate being run by a business, one, it accelerates the payback period on capital investments to improve the efficiencies of vehicles. And as Lou showed, it's already cheaper to run a vehicle on electricity than it is to run it on gas. So the more you up the utilization of a vehicle, the more the economics work out around electrification. And two, you're moving the decision point away from the retail end consumer and their demands for a very high rate of return to businesses who are a little bit more rational about capital allocation and are more likely to take advantage of the economic opportunities offered by electric vehicles. And that doesn't even take into account some of the minor technical or operational advantages that electric vehicles might have. And this is something we are already seeing. I think this is our survey. We did a survey of all companies developing autonomous vehicles in California last year. Most of them are developing on a pure electric platform. Another significant minority are doing hybrid. And this is actually not on a per vehicle basis. This is on a per company or per platform basis. If you look on a per vehicle basis, I think over 90% of autonomous vehicles would be battery electric vehicles or FEVs. So already companies are either anticipating or think that their current business, anticipating that their future model or their future regulations, or already in current their programs and their businesses are best served by electric vehicles. So we think the adoption of autonomous vehicles helps accelerate electrification. A couple minor points in closing. I think. I know my time is running short. I would say I spoke about integrating all different aspects of the system. I think there's a lot of really interesting work that shows that the broader the set of levers that one organization encompasses, the more global optimization they can do. So the left is a simulation of how many vehicles it takes to serve all the trips in New Jersey. And Alan Kornhauser from Princeton showed that you could do with about 10% of the fleet of currently personally owned vehicles in Princeton. Obviously, that's very aspirational, but he showed that there's an optimal mix of small, medium, and large-sized vehicles that are deployed at different times a day. And if you want to optimize for the fewest vehicles on the road, that gives you a very different sort of distribution of shapes than you currently have in the personal vehicle market. And then really one of the most interesting things I saw is this simulation that was done by scientists at the Lawrence Berkeley Lab, where they showed that, let's say they did a simulation of taxi rides in New York City. And they said, let's say you wanted to serve all the rides that are demanded fulfilled by taxis in New York City now using electric vehicles. They said you would actually, and you could control not just the cars you bought, but the infrastructure, the charging infrastructure. They said the optimal battery size could be as small as 70 miles because rather than invest in a larger battery, you should invest. It's more optimal to invest in the charging infrastructure so you can stay charged in between rides. And that tells me that the more we connect the different aspects and decision, the levels of the system, the more global optimum we can get to in terms of efficiency. I think that sense is that's not currently happening with transportation with TNCs like Uber or Lyft because of the independent contractor structure means that those decisions Uber doesn't optimize. Uber and Lyft don't optimize that decisions, and actually can't because that would interfere with the independent contractor status. But that's something that could evolve either through autonomous vehicles, which are likely to be owned by fleets, or through any change in the independent contractor status. Finally, I would say let's keep in mind that a lot of the deployments might need to be tailored for the built environments. Because that has the biggest driver of fuel efficiencies, and we've done some work to simulate how autonomous vehicles might interact with the built environment. And our biggest policy recommendations around getting to this outcome are one, promoting new technologies that don't intrinsically drive efficiency. Paul will probably talk a lot more about that, but give us a greater set of policy and incentive levers to drive efficiency, and better understand the policy trade-offs between modes of transportation. Right now, there's a very complex web of regulations that combine the powertrain of the vehicle are regulated at the national level through fuel efficiency. The operational restrictions on taxis are done by local levels. Infrastructure is done through PUCs. So the more we can connect different modes of transportation under as a unified regulatory structure as possible, I think the more you can manage and encourage global optimization. And so I think that I think would be our banner recommendation, what we're focusing on. I really appreciate the audience's indulgence, and I look forward to answering any questions.
People should feel free to come closer if they like. Even if I did bite, I can't bite at these distances, but good job. Well, hello. Thank you for being here. I'm here to talk about energy and travel demand implications of automation and shared mobility. How's this working? Good. And I want to present some of the results of a large program that's underway, funded by the Department of Energy, called the Smart Mobility Lab Consortium. My work is part of my work is through that consortium, and then I'm going to talk about two other projects in that consortium. It's one of many large, ambitious efforts to try to understand these issues of new vehicle technologies and what they mean for transportation energy use and ultimately emissions. So I'm Paul Leiby. I work at Oak Ridge National Laboratory. I'm really glad to be here. And I want to talk about the estimated effects of automation on travel demand and energy efficiency, trying to decompose what some of those effects are, and talk also about how shared mobility affects vehicle miles traveled as it provides passenger miles traveled. I'll comment briefly on the suitability of electrification for shared and automated mobility. Amitai just talked about that. It's still a not fully understood question, but then show some results for net implications for travel and energy use. So like Amitai mentioned, we find this kind of decomposition framework useful for understanding the problem. It's been called by Lee Schipper the as-if framework: activity, share, intensity, and fuel in a chain. Decisions in each of those areas determine the types of travel that are undertaken and the modes that are used, and the energy intensity of those modes, and then the fuel choice determines the emissions. And so we use a similar framework to structure our analysis. But one of the points I want to make very saliently is that I think it's, while we're interested in global optimization, we're interested in societal benefit. We have a combined market-based system, and there's a strong influence of economic choices by consumers and firms in terms of the outcomes. And so a simple thing to always be attentive to is cost. And this diagram, while it might not be annotated as clearly as it could be, it begins with the question of what does it cost to drive. And on the left there are 3 bars. Let's see if this, okay, so I'm not going to be pointing because the pointer's tired. But the 3 bars on the left are the base case, basically current travel costs, beginning with heavy-duty trucks, and then light passenger trucks, and then cars. And the bars decompose the cost based on a lot of published evidence into the standard things that you might read about when you're looking at the American Automobile Association reports or the trucking industry reports. They're the costs of insurance, the costs of fuel, the cost of maintenance, parking, time cost for being in the vehicle, and the vehicle capital cost. So those are the costs from top to bottom. And on the right are reasonable estimates of what the cost might be for automated vehicle, assuming we achieve some of our technological objectives. And so you can see right off they're much smaller. But the most important thing to mention, and maybe one of the most obvious things, but still one of the most difficult challenges to fully understand, is the role of time and the value of time spent traveling for the prospects for future use of automated vehicles, future travel in automated vehicles, and also people's willingness to engage in shared mobility. And I'll emphasize from the beginning, we're really interested in pooled mobility. I'll use that word to always distinguish between multiple passengers, independent passengers traveling together versus single passengers traveling sequentially. They mean radically different things for travel and energy outcomes. So the point here is that travel costs per mile are composed to the largest extent by the value of travel time, according to almost all reasonable estimates. And the ones on the left for the heavy-duty truck are clearly monetizable based on wages of the drivers. So they are the largest single component of cost. Fuel is only 15% of the cost for a typical car. It's 35% of the cost for trucks. So there's 2 strong reasons for automation for fuels to reduce the cost of driver's time and the cost of fuel use. But there's a very strong motivation for automation for private passengers as well, if they can recover some of that time, a significant fraction of their time spent in traveling. So what we do is we then, as I say, we want to decompose the different effects, and we're able to identify a number of mechanisms, ways by which the technologies associated with automation can alter travel energy intensity, vehicle energy intensity. All the items above the line are associated with vehicle energy intensity, and it also could have profound effects on travel demand and trip generation. So you may have seen pictures like this. We had one in an earlier paper in 2016. We've been working on